Hey everyone, and welcome back to Leather of Finance. So, let's talk. The world of investing can feel, a little crazy sometimes, right? It feels like every single day there's a new product, new strategy, and you can't miss opportunity. And now here is that more true than with ETFs, exchange traded funds. You've heard of them. They are the cool investment products that bundle together a bunch of stocks or bonds into one basket. But you can buy and sell them as easily as a single stock. And lately, they have absolutely exploded. It's kind of mind blowing actually. In 2024 alone, investors poured a staggering $1.1 trillion into ETFs in the US. That smashed the old record from 2021. The number of ETFs out there jumped by 17% in just 1 year. And this year, it looks like even more money is flowing in. It seems like, as one strategist, Cynthia Murphy, put it,
Even in times of market volatility and uncertainty, investors are turning more to ETFs.
instead of just sitting on their cash. And it's a real mix of what people are buying. On one hand, you have tons of money going into a big classic funds. I mean, the Vanguard S&P 500 ETF took in 115 billion last year, and it's already pulled in another 66 billion in the first half of the year. As Murphy says,
That's an insane amount of money. It's long-term buy and hold investing.
but at the same time, some really, let's call them esoteric ETFs, are getting a lot of attention too. I'm talking about crypto ETFs. Aniket Olo, our at CFRA research called them amount of money flowing into them staggering. Get this, one iShare fund that tracked the actual correct price of Bitcoin pulled in 6 billion in the month of May alone. There are also super specialized funds, like one that use leverage to try and goose returns on a single stock, and covered call funds that generate income by selling options. So you've got this whole universe of options from the plain vanilla to the super exotic, and it's about to get even crazier. There's another huge wave of ETFs coming. See, the SEC is accepted to approve a rule of change that will be a massive deal for the industry. Big names like BlackRock, Fidelity, and Vanguard have all applied for something called ETF share class exemptions. In simple terms, it means they will be able to take their existing popular mutual funds and offer them as an ETF. One lawyer who specialized in this stuff, Ashia Hunt, said,
This is a transformative development in the fund industry, and everyone is preparing for it.
and this could be great news for regular investors like us. It may give us access to some really great actively managed funds that used to be hard to buy without paying big fees or going through an advisor. Now, not every single mutual fund is going to do this, but we can definitely accept it a bonanza of new launches. And that brings us to the big question. As Cynthia Murphy said,
Choice is always great, but it can also be overwhelming.
she's right. When there are thousands of options, how do you even begin to choose? Well, that's where we come in. Here at the Leader of Finance, we've been running our list of favorite ETFs for a few years now. Our goal is cut the through the noise and give you curated list of what we think we same of the best found out there. And I'm happy to say our peak have held up really well, even through the recent market craziness. Over the past 12 months, our international stock funds returned an average of 19.1%, and every single one of our bonds funds beat the big bond benchmark. Each year, we do a deep dive and make any changes we think are necessary. This year, we are making three changes. Now, remember, this isn't a really made portfolio. Think of it as a list of high quality ingredients. You decide what do your portfolio need, and you can use these funds to build something that's perfect for you. All right, let's get into the good stuff. Here are our favorite ETFs for the year ahead. Think of your portfolio like a pyramid. These core funds are the big steady base. First up, the iShare Core S&P 500. This is your foundation. It tracks the S&P 500 index, which covers about 85% of the US stock market, and it is dirt cheap with a 0.03% expense ratio. Its market cap widget, meaning the biggest companies like Microsoft and Apple make up the biggest slice of the fund. Next, we pair that with its siblings, the iShare Core S&P Mid Cap and Small Cap funds. The best part here is that there's no overlap between these three funds. The mid-cap funds hold companies that have made it past the risky startup phase, but are still nimble and growing. And the small-cap funds focusing on up and coming firms. Both of them have a neat little quality filter. Companies have to be profitable to get in. For those who want to be invest with their values, we have the iShare ESG Optimized MSCI USA. This fund got a new name recently, but it still does the same thing. It avoids businesses like firearms and tobacco and favors companies that score well on environmental, social, and governance, or ESG miseries. It won't necessarily beat the S&P 500, but it's designed for people who want to be invest in the companies with leading ESG practices. And for your international exposure, we love the Vanguard Total International Stock Market. It's a fantastic one-stop shop that give you exposure to almost 8,000 stocks in both developed and emerging markets all over the world. And it's been another with an 18.2% return over the past year. Who doesn't love getting paid just for owning an investment? First, a really interesting one, Capital Group Dividended Value. This ETF is pretty new, but the team behind it has been running the same strategy for 24 years. Their goal is simple, invest in established US companies that pay a higher dividend yield than S&P 500. They have a unique system where the funds is split into 6 slaves, each run independently by a different manager or a team. The result, a diversified portfolio of about 52 stocks that has crashed its peers and the S&P 500 over the past 3 years with lower volatility. Its 3-year return has been 99% of similar funds. Wow. For international dividends, we have the iShare International Dividend Growth. We actually just added this one in February because it had better return and lower volatility than our old peak. So far, so good. It's gianted 17.8% since the start of the year. It looks for companies outside the US that have a solid history of increasing their dividends for the last 5 years. Finally, there's the Vanguard dividended application. With this one, it's about dividended growth, not necessarily the highest yield right now. It tracks an index of companies that have consistently raised their payout for over a decade. So you see big growth oriented names like Microsoft and Broadcom at the top. Alright, now for the funds that can add a little space to your portfolio. Healthcare Select Sector SPDR. Okay, I will be honest. The healthcare sector has had a rug go off it lately. But we see a real opportunity here. These companies are still innovating and helping people live longer lives. And right now, the stocks are trading at about a 25% discounted compared to the S&P 500. That's a huge discount from their long-term average, which make us think it could be great value play. Invesco S&P 500 equal widget. We added this one earlier in the year because we took the rest of the market was due to catch up the handful of mega cap tech stock. That happened for about nanosecond. But we are keep it because it's a super simple way to reduce the risk of having too much of your money tied up to just a few giant companies. In this fund, every company gets an equal slice of the pie. I share core MSCI emerging markets. Not gonna lie, we were a little worried about we added this one last year because emerging markets has been struggling for a while. But wow, has the tide turned? Over the past 12 months, the fund has joined 16%. A rebound in China helped, and analysis expect earning growth to stay strong across the developing world. JP Morgan US Quality Factor. Everyone says they want to be own high quality companies, the ones with strong balance sheet and smart manager. Well, this fund uses a quantitative system to find them, screening for things like profitability and financial risk. SPDR S&P can show new economies. This is a cool one. It invests in a whole bunch of forward-looking themes at once, like automation, crypto technologies, and clean energy. Because it spreads its bets, it's a potentially low-risk way to invest those new things that can be super volatilities. And it's done well, claiming over 19% in the last year. Technology Select Sector SPDR. A year ago, this fund was our top performer. It's cooled off a bit since then, but we still like it. Why? Because over the long haul, 5 and 10 years, it was delivered fantastic return with the less risk than other tech funds. Plus, analysts are still projecting really strong earning growth for the sector around 19% over the next 5 years. Last but not least, let's talk bonds. The bond market has been a wild ride lately, but these funds have helped navigate the storm. Fidelity Total Bond. This is an actively managed fund that's consistently beating its benchmark. It holds a mix of bonds and currently yields a solid 5%. Invesco BulletShare 2026 Corporated Bond. We almost took this one off the list because, as the name says, it's designed to mature and pay out in 2026. But we are keeping it for one more year because it has been about half as volatile as its benchmark while still delivering better returns. SPDR, Double Line Total Return Tactical. This fund is run by the gurus Jeffrey Gandelich and Jeffrey Sherman. They've done a great job by focusing on non-traditional sectors and keeping the fund's sensitivity in interest rate change low, which has really paid off. It currently yields 5.4%. iShare Short Duration Bound Active. In these uncertain times, this actively managed short-term bonds fund has been a star, returning 6.6% over the past year. And its 4.6% yield beats what you will find in most money market funds right now. JP Morgan Income. We love this one because it does the hard work for you, shifting between different type of bonds to find the best opportunities. Co-manager Andrew Norelli says their goal is to deliver the maximum income for a prudent level of risk. The strategy has a long track record of beating the benchmark with about one-third less volatility. It yields 5.2%. And finally, PIMCO 0 to 5 year high yield corporate bond. This fund is a fascinating hybrid between active and passive. They use a huge team of analytics to handpick the best bonds and replicate their index, which has led to lower default rate and great returns. They found 9.6 annualized return over the past 3 years, beat the 84% of its peers, and that yield every attractive 6.7%. Wow, okay, that was a lot. I know it. But hopefully breaking down the ETF 20 give you a great starting point for building or tweaking your own portfolio. The world of ETFs is only going to get bigger, and a little guidance can go a long way. What do you think? Do any of these funds stand out to you? Are there any you already own it? Let me know down in a comment. I'd love to hear from you. As always, thank you so much for watching. If you found this helpful, give the video a thumbs up and make sure you are subscribed so you don't miss what's the next. Until the next time, happy investing.